The turmoil and uncertainty of the current market is pretty obvious when you see numbers as big as $5 trillion, which is the amount that was wiped off the market cap in just 3 weeks of bad trading. US stock market loses $5 trillion of value in just 3 weeks. The S&P 500's rapid 10% decline from a record high into correction territory has wiped out trillions of dollars in market value. The market value of the S&P 500 at its February 19th peak was $52.06 trillion according to FactSet. Thursday's decline put the index's market value at $46.78 trillion. That makes for a total loss of about $5.28 trillion in about 3 weeks. And these numbers are kind of meaningless, but they become more visceral when you start to see pictures like this, which is basically every company in the S&P 500 or in various stock market portfolios, and they're all red. Every single one of them is losing billions or tens of billions of dollars in value. But up top, I want to say that there is no need to panic. We have seen this kind of situation before, and we know now how to navigate it. So in this video, I want to cover what happened, why it happened, whether you should be concerned, and how you can react in order to take advantage of any opportunities this might cause, or at the very least not realize any losses. So for what happened, there's kind of not much more to say. For a variety of reasons that we'll discuss in a second, the US investors have been really spooked this past few months, and as a result have been selling off stocks at an incredible rate. This has led the stock market to drop about 10%, wiping off about 6 months of growth. As we can see here, February 19th was the peak, and then down here we're down minus 10.13%. And if we were to drag that back over to when the last time that it was at that low of let's see, what is that, 52.21. So we're looking at about 6 months of loss, with it being down 1% over the last 6 months. That much is easy to see. Anyone can look at the numbers and see year to date or in the last year or so, it is up or down X%. The real story here is why it happened. And basically, it's a lot of reasons that have all hit at the exact same time, causing investors to be spooked and sell off their shares. These include things like tariffs, weakened consumer sentiment, weakened consumer spending, the Federal Reserve revising down the GDP predictions, and inflation staying high. And I know that seems like a lot, but I promise we're going to cover it all just briefly enough so that you stay informed as to what's happened, but not so in depth that you become overwhelmed with the amount of information there is out there. But the very first thing you have to understand before we jump in is that markets shift pretty considerably every election depending on which side wins. And the NASDAQ has a pretty good couple paragraphs about this. If you're going to invest in American stocks, there's an important fact about the United States politics that you should keep in mind. Specifically, each of the political parties has sectors of the economy that it tends to support more than the opposing party. Furthermore, when Republicans and Democrats are in office, they usually reward their supporters and often take steps to harm the opposing party's backers. This means that if a certain party wins, you can expect some stocks to surge. Moreover, in our system, the party that controls the White House has tremendous power over regulators and can often get Congress to pass much of its agenda. Consequently, investing in sectors backed by the party that controls the White House is often very profitable. So you can imagine that when a Republican gets elected, like in the case of Donald Trump, they tend to support things like less regulation, fossil fuels, and defense spend. And as a result of that, industries like banking, defense contractors, and energy suppliers like ExxonMobil benefit greatly. And it's kind of the same thing for Democrats as well. 3 no-brainer stocks to buy if Kamala Harris and Democrats sweep in November. Now, this was written back in October, back when it still seemed like the Democrats had a chance of winning, but Democrats, by and large, favor things like green energy, healthcare spending, and housing. So if a Democrat would have won, they didn't obviously, but if a Democrat would have won, then you could have expected green energy stocks to skyrocket. Any companies that were providing affordable housing that might get government contracts for that to go up, healthcare spending to increase as well, and companies like United Healthcare to do well. Every time there's an election, the market will shift towards whatever the priorities of the incoming party are. And while this time is a little different, we are seeing that same reshuffling. But with that aside, let's talk about what specifically we're seeing this year that's different. And the first thing we have to talk about is the trade war. BBC has a pretty good few articles on it, and here's what they have to say. U.S. stock markets fall amid trade war fears. The U.S. stock markets have tumbled over concerns that President Donald Trump's tariffs in Canada, Mexico, and China will lead to a wider trade war and hurt the economy. The S&P 500 index, which tracks 500 of the biggest companies in the US, fell for a second day, ending at its lowest level since November when Trump won the election. Remember, after Trump won, stocks kind of skyrocketed everywhere, thinking that Trump was going to lower taxes and people were going to have more money to spend buying products from these companies. The president has followed through on the threat to impose 25% tariffs on imports from Canada and Mexico and a 20% levy on China. The move drew swift retaliation, including from Canada, where Prime Minister Justin Trudeau warned Trump his decision to target US neighbor and close trade partners was, quote, a very dumb thing to do. Trump fired back, writing on social media, "Please explain to Governor Trudeau of Canada that when he puts on a retaliatory tariff on the US, our reciprocal tariff will immediately increase by a like amount." Now, there are other factors, of course, leading to the economic downturn that we saw, but by and large, this is the big reason that we are scared. Tariffs on other countries mean more expensive products and higher prices for American citizens, and retaliatory tariffs from those countries on America mean more expensive products and higher prices for everyone involved. And here we can see on Wikipedia is a summary of all the tariffs that have gone into effect. It's down here at the bottom. There's a 25% tariff on steel and aluminum that's currently in effect, and then most of these are either in effect or partially in effect. 25% tariff on most Canadian goods, 10% tariff on Canadian oil and gas, 20% tariff on all Chinese goods, which is called the levy. That just means a blanket tariff across everything. A 25% tariff on all Mexican goods. Some of these are delays, some of these are partially in effect, and some of these are currently in effect. But what you can notice here is that there's also another section called proposed tariffs. These are tariffs that might be coming down the pipeline, or some of these that are either delayed or partially in effect are also going to be stronger as they come down the pipeline more, which means that if things are not more expensive yet, like maybe Canadian oil and gas, the tariff probably will go into effect on April 2nd, it looks like. It's not more expensive yet, but it's going to become more expensive as soon as that tariff hits. Basically, people were seeing two things at once. They were seeing stock markets hit all-time highs, and then they were seeing Donald Trump start enacting tariffs against some of the closest allies that the United States has. So they started selling off quickly, worried that when the tariffs went into effect, the stock market would drop anyway, and they would lose a bunch of money that they could have gotten if they had just cashed out of the market. They essentially had a "this is as good as it's going to get" mentality. So while it was at its peak, they started selling off like crazy to go ahead and take the money they could, and then they were probably going to hold on to that money, maybe invest it in US treasuries or in a high yield savings account, and wait for the market to go down, and then they can put it all back in the market when it's low and cheap, and then let the market go back up and make a bunch more money. Now, to be clear, the tariffs are not the only issue. There's some other ones that we're going to talk about, but they basically are the snowball that got everything rolling, or maybe the crater that caused a ripple effect that started damaging other aspects of the economy that also helped the markets continue to go down, with one of the big ones being general consumer sentiment, and as a result of consumer sentiment, consumer spending. We can see the consumer sentiment report here. It says consumer sentiment slid another 11% this month. This is in March 28th, with declines seen consistently across all age groups by age, education, income, wealth, political affiliations, and geographic regions. So everyone of every demographic is agreeing that they think the economy is going to have a downturn. Sentiment has now fallen for 3 consecutive months and is currently down 22% from December of 2024. Remember, after Donald Trump was elected, people really thought that things were going to get much better, and then we started seeing all the tariffs. While current economic conditions were little changed, expectations for future deteriorations across multiple facets of the economy, including personal finances, the labor markets, inflation, business conditions, and stock markets. Many consumers cited high levels of uncertainty around policy and other economic factors. Frequent gyrations of economic policies make it very difficult for consumers to plan for the future, regardless of one's policy preferences. So basically, people are saying it's hard for anyone, no matter their political party, to be able to plan for the future. If tariffs are being put on, then taken off, then maybe they'll be on, then maybe they'll be off, and no one really knows what's going on. Consumers from all three political affiliations are in agreement that the outlook has weakened since February. Despite their greater confidence following the election, Republicans posted a sizable 10% decline in their expectations index in March. For independent Republicans, the expectations index declined an even steeper 12% and 24% respectively. So everyone across all demographics, including Republicans, including Democrats, and including independents, is all believing that things are going to get considerably worse. But there's just a little bit more. Year-ahead inflation expectations jumped from 4.3% last month to 4.9% this month, the highest reading since November of 2022, and marking 3 consecutive months of unusually large increases of 0.5 percentage points or more. This month's rise was even seen across all three political affiliations. Long-run inflation expectations surged from 3.5% in February to 3.9% in March. This is the largest month-over-month increase since 1993, stemming from sizable rise among independents and follow an already large increase in February. So people think two things. One, they think the economy is going to get worse, and they have a poor sentiment of the economic outlook in the next year. And two, they think inflation is also going to get worse. And not only do they think it's going to get worse, but they think it's going to get worse than they had previously thought that it was going to be. And this is, by and large, regardless of political affiliation. So Republicans think it's going to get worse, independents think it's going to get worse, and Democrats also think it's going to get worse. Now, to be fair, more Democrats think it's going to get more worse, but Republicans, by and large, do agree that things are going to get bad as well. And generally, when consumer sentiment goes down, consumer spending goes down as well, because if you think things are going to get worse, then of course you are going to spend less money because you think things are going to be bad in the future. So you're going to pull back on your spending now and save up a little more just in case the economy turns down and you you'll lose your job, etc., etc. Reuters has some more on this. U.S. consumer spending posts first drop in almost 2 years. And this article, I believe, is from late February, talking about January's results. U.S. consumer spending fell for the first time in nearly 2 years in January, and the goods trade deficit widened to a record high as businesses front-loaded imports to avoid tariffs, setting up the economy for weak growth or even a contraction this quarter. While the data from the Commerce Department on Friday also slowed to a moderation in annual inflation last month, prices showed some stickiness with fairly solid monthly gains. In addition, President Donald Trump's administration is ratcheting up tariffs, which economists say would raise prices as businesses pass the higher costs of imported goods to consumers. Now, to be fair, February consumer spending did go up a little bit, about 0.2% if memory serves. But even though it went up less than people had expected. Economists, with all this information, had predicted it would go up like 0.3 or 0.4%, but it did not go up as much as people thought, which is also a bad sign because that means consumers are less likely to be spending more money because they're worried about a possible recession. So you can see why this causes kind of a downward spiral. Consumers are worried about a downturn, so they stop spending money. Well, then companies don't get money. And so investors, seeing that the companies aren't being as profitable as they have been in the past, start bailing, which makes the markets go down. And then the consumers see that the market is going down, so then they get worried about a downturn. And then they stop spending money, and then companies don't make money, and so on and so forth. You get the idea. Now, it makes sense that seeing tariffs go up and the stock market go down would impact consumer sentiment. But another big aspect of consumer sentiment and just how generally people feel about the state of the economy and what it's going to look like in the future is the Federal Reserve predictions, both for the GDP and also the Federal Reserve reports on what inflation looks like today. And both of those reports have not been going great, particularly recently. The New York Times talks about this and says economists are bracing for intensifying price pressures as slower growth poses a challenges for the Federal Reserve. Inflation eased more than expected in February, a welcome sign for the Federal Reserve as it grapples with the prospect of higher prices and slower growth as a result of President Donald Trump's trade war. The consumer price index was up 2.8% from a year earlier, after rising another 0.2% on a monthly basis. That was a step down from January's surprisingly large 0.5% increase and came in below economists' expectations. But just to be clear, just because it came in below economists' expectations does not mean that it's good. It just means that what they expected was bad and what came in was slightly less bad. At 2.8%, it's still well above the 2% target, which means we don't get any kind of a rate cut, and it also means that it's still generally going up. We can see here that it was starting to come down in May and June, great, but then in July it went up a little. In August, it went up. September, October, up. November, December, January, and February, it's come down a little bit. But if we can look at the graph here, we can see that it, by and large, after coming down majorly from highs, is starting to trend back up, with February not being as high as the previous month being an exception and not the rule. And consumers feel this. And because they feel that prices are going up, they're worried again about a general recession. And so they're going to hold on to that money more. And it's not just inflation numbers that have got investors and consumers spooked. It's also the predictions for the GDP as well. In its quarterly economic projection, the committee lowered, this is the Federal Reserve, lowered its full year 2025 GDP growth expectation to 1.7%, down from the 2.1% that it forecasted in December. The current unemployment rate is 4.1%, and the committee expects the median rate to be 4.4% at the end of the year. Some near-term measures of inflation expectations have also recently moved up, both in markets and survey-based results, Powell said. Consumers and businesses responding to these surveys cited tariffs as a driving factor. I hope what I'm able to demonstrate to you is that people everywhere are generally worried about the economy. Between the tariffs and the economic back and forth and the government budget proposals that don't actually address spending or any of the issues that are actually facing Americans, people are just not having it right now, and as a result are pulling back and waiting to see what happens next. So there's a lot going on, too much for even me to keep up with. But the real question is, should you be worried? And the answer is yes and no. And let me explain. This is not the first time the stock market has lost a ton of money. And every time that's happened, it's recovered. And let me show you some examples. This is an article about the dot-com bubble. It burst 25 years ago. What does that say about history today? Well, we can look down here and we can see within weeks of that high, the index, the S&P 500, with a mix of factors spooking investors. Eventually, the NASDAQ, not S&P 500, fell more than 75% of its value, wiping out $5 trillion in market capitalization. The age of irrational exuberance was over. $5 trillion. Well, that's actually the same that we're seeing today, except this was in the year 2000, which means $5 trillion in today's money. It's probably far higher than that. But there's not just that. The stock market crash of 2008, this is from Investopedia. Between 2007 and 2009, the U.S. households lost over $16 trillion in net worth. The value of the stock market fell by half, and unemployment reached 10% in the crisis known as the Great Depression. But that's not the only one. Global stock markets have lost $6 trillion of value in just 6 days. This is at the start of the pandemic. But then more recently, in 2022, stock markets losses wipe out $9 trillion from Americans as well. This is when inflation started to go crazy and people were running out of money from their pandemic stimulus. So this $5 trillion market drop, not only is it not unheard of, but it's actually almost kind of not even that bad. In every instance of the stock market taking huge losses that we've ever looked at, it's gotten better. And not only has it gotten better, it's reached new highs. If we go back to this S&P 500 chart and we go to max, each of these dips is one of those things that I just talked about. There it is, the the dot-com bubble burst, the housing market crash, and here we've got the pandemic, and then here we've got the inflation crisis crashing the market. And every single time we've reached new highs. If you were to stay invested over from, let's say, the year 2000 all the way to today, your money would have more than tripled in 25 years. Panic is not the solution here. The solution is to know that the stock market will go back up. So the best thing to do is to keep investing regularly like you normally would, unless of course you lose your job, in which case hold on to that money until you find a new one. The market will recover. It always does. And the only reason I would panic is if like maybe your entire investments for retirement were tied up in, say, Tesla stock. That could be concerning, and please seek a financial advisor out immediately. Thanks for watching.